So the regulatory environment continues to evolve. We've read about more transparency around hedge funds. I think you alluded to that in your comments. A less sexier asset class is money market, but we're going to have new SEC rules around money markets. And you're certainly talking to clients about capital preservation within your defined benefit plans and defined contribution plans. Talk a little bit about perspective around these SEC money market rules and how you think that impacts your clients.
Sure. So in terms of, we look at what's going on in the money market world and kind of the impact on the fixed income markets in general. I mean, the fact of the matter is, with money market funds, I guess, being more required to be more conservative, whether it be from a duration perspective or credit quality, is going to impact the liquidity in typically, credit markets. And we think with that particular impact, I think valuations within that area, supply and demand with that area, trading with that area, you're going to see some reverberations across the markets, which again, we're not sure exactly how they're going to play because the regulations, haven't been in place yet.
So, I mean, back in 2008, there were several money market funds that potentially could have broken the buck, stepped in to kind of preserve that $1 NAV. Now we're hearing that there could be liquidity gates. We're not sure, to your point, exactly to whom these, whether it's going to be a government money market fund or a traditional treasury funded money market fund that's going to be impacted. I guess if you're a plan sponsor, what do? You just sit back and do a lot of due diligence. You kind of understand what products and services you have or what products exist in your program today?
Yeah, so essentially when talking to plan sponsors, our general sense is that you should probably be a little bit ahead of the curve in that you're correct. You're going to move toward a treasury government type portfolio, and you don't want to be in a position where you have to liquidate investment grade securities reactively. You'd rather be proactive. So if it's coming, you might as well just move to something more conservative and get those allocations elsewhere.
In terms of shifting gears, I know we're kind of jumping all over the place, but in terms of allocations, asset allocations, are you seeing clients shifting to one particular asset class over another within the defined benefit plans? Are they moving more towards capital preservation? We've had volatility in the markets for the last several months. What are clients doing in terms of their allocations?
Sure. So, our client base is typically corporate pension plans, and there's been this general de-risking philosophy where they're moving more toward fixed income assets, more toward LDI type strategies, more of a desire to make their volatility relative to their funded status less so. We're seeing inklings today of re-risking, which is taking 5 years. But I think we're finally at that point. I think a number of U.S. corporate pension plans, we're getting close to having that buyout, this conversation, getting close to being fully funded, getting close to a more definitive LDI strategy. Will they be putting more and more into fixed income, building up those corporate bond portfolios? Fortunately or unfortunately, the environment over the last 12 months where volatility has picked up, equity markets are not cooperating in terms of helping them reach fully funded status. And, rates, we're talking today, rates are probably going to start inching up. So, which would be good for funded status. So it's all those dynamics where, again, there's been a shift to fixed income, but we're seeing inklings of possibly going back to equities.
And we always talk about collaboration on staying ahead of the curve and at CAMAC Retirement Group, collaborating with the plan sponsor, collaborating with the outside counsel and the record keeper. But you have to do, as an asset management firm and also a consultancy, you have to collaborate with the actuary on a defined benefit plan, right?
Sure.
I mean, that's a partnership.
Absolutely. And, we, with a lot of our heritage coming from the plan sponsor side, I mean, it is so important to get all stakeholders involved in this decision making. And with the ever-changing regulatory environment, you just can't know everything. I mean, having a plan sponsor have the right professionals across everything they do is so important. As you can imagine, the actuaries is one of those key players in there.
Gino, Reina, thanks for joining us on Staying Ahead of the Curve.
Thank you, Jeff.
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 Curve.
Thank you, Jeff.